was really prepared for another REBAP, a REBAP chapter na nag-invite na sa akin since December. Pero it's the same presentation actually. So nauna pa kayo sa kanila. So anyway, so based on what Joey, this has been done by a research team headed by Joey Bontoc. So I hope I do justice to this presentation. So we have prepared, or our research team has prepared, the Philippine Property Outlook, and it says we are gearing up for an economic rebound in 2021. So this is the Philippine economy. As you can see that during the third quarter of last year, the Philippine economy contracted the lowest. It dipped the lowest, the slowest in 22 years. So the Philippine economy contracted by another 11.5 in the third quarter of 2020. The country posted a contraction of 10% in the first 9 months of 2020. But despite this, the finance chief, Carlos Dominguez, is optimistic for a faster economic rebound in 2021, especially with the prospect of an effective vaccine against COVID-19 being rolled out in the second to the third quarter of 2021. So again, this is the sentiment. This is the general sentiment, not only in the Philippines but globally, that the vaccine might be able to help us move forward. So a major plank of the economic growth beyond 2021 will likely be the implementation of crucial infrastructure projects within and outside Metro Manila. So this is where this will be the drivers for the movement in terms of expenditures. This will be in terms of government spending for those infrastructure projects. This includes the completion and upgrading of railways, toll roads, and airports across the Philippines that should contribute to higher land and property values. So the projects are also likely to play an important role in dictating the development strategies of property firms beyond the pandemic. So the infrastructure projects are really meant to also spur the development of our developers. So where they see that the infrastructure are going to be built, normally developments are going to be faster in those areas. So timely approval and implementation of the 2021 national budget is crucial in supporting economic growth in 2021. Also, the continued construction of public projects such as roads, airports, and bridges is likely to stoke the property development sector. For 2021, the government has set aside 109 billion or US dollars 2.3 billion for the transportation department and about 667 billion pesos or 13.9 billion for the Department of Public Works and Highways. So these allocations will likely support the construction of infrastructure across the country beyond the current administration's term, and public projects should also stoke demand for integrated communities outside of Metro Manila beyond 2022. Now, earlier today, we got this result of the survey, a global survey within our company, looking at the investment sentiments globally. So what are the most general that investors are fearing is really the weak economy of the different countries. So it's not only us, but really especially in the what we call the developed countries, which are highly affected by what is happening right now. So these are the upcoming infrastructure projects in Metro Manila. We're looking at LRT2 is extension with completion in this year. MRT LRT Common Station again this year. MRT Line 7 in 2022. MRT Line 4 in 2025. Metro Manila Subway 2026. And then the Skyway Stage 3 in 2020, which already, I think most of you have already tried this. The NLEX SLEX Connector Road for completion this year. The Skyway SLEX Extension, again for completion this year. The Estrella Pantaleon Bridge connecting Makati and Mandaluyong this year. The BGC or Tigas Link Bridge for this year, and Clark Airport modernization this year also. The NAIA redevelopment in 2024 and the Bulacan International Airport in 2025. As you can see, based on these upcoming infrastructure projects, most of them will be completed this year. And we know that infrastructure is a great driver in terms of economic growth. So in terms of the office leasing market, the landlords are to adjust to a challenging office leasing market in 2021. So we're saying that this will be a challenging office leasing market because of the departures or because of the vacant spaces left by the POGOs. While some traditional and outsourcing firms have either closed shop or are rationalizing their office footprint. So what we're saying here is that one of the things that is affecting the office leasing market is really the work from home strategy. We know that most of the offices right now are either are using the work from home setup, or they do it on a 50 or a hybrid or a 50-50, or they would normally go for what we call office co-working spaces, where the bulk of the employees are not concentrated in one area because of the challenge of the COVID pandemic. So as of 9 months 2020, or as of September 2020, the net take-up of office space has turned negative. This is the first time that office space has gone down. Instead of going up, the net take-up went down. So meaning there were more departures from the office spaces rather than those coming in and getting more spaces. So Colliers has recorded a net take-up of minus 113 square meters as of the 9 months 2020, down from the 605,600 square meters absorbed as of the same period in 2019. Hence, Colliers sees office vacancy in Metro Manila reaching 9.1% at the end of 2020 from 4.3% in 2019. So as you can see, 9.1 is a huge number for vacancy, considering that traditionally Metro Manila has been experiencing vacancies in the sub 5%. As POGOs continue to vacate spaces and outsourcing and traditional tenants rationalize their office requirements. So for 2021, Colliers projects net take-up to reach 250,000 square meters, with vacancy rising further to 11.6. So again, as I've mentioned, that traditionally office leasing or office occupancy vacancy has never reached a double digit for the last couple of years. New supply in Metro Manila is also likely to be affected by the pandemic. Colliers sees office completion in 2021 reaching 632,600 square meters, down 35% from the initial projection of 969 square meters at the start of 2020. So this is the graph which shows the movement in terms of the availability, the supply, the net take-up, and the vacancy rate. So you can see that since 2016, the vacancy was just around 5.3, 4.7, 4.3. But since 2020 full year, it was projected at 9.1. Well, by the way, our year-end, the year-end report of Colliers will be coming out on the first week of February. So that will be the fourth quarter of 2020. So again, this is as I've mentioned, that Colliers is projecting an 11.6 for 2021 vacancy and another at 11.5 by 2022. So office leasing recovery will primarily hinge on recovery of general business sentiment, which would entice local businesses to reopen, and recovery of global economies that outsource services from the Philippines. So the key segments would be telecommunications, medical coding, health information management, and e-commerce should partly help lift leasing starting the second half of 2021. So this would be the essential industries that are doing well in spite of the pandemic. While most leasing is momentarily paused, some occupiers are still actively looking for office space, especially those that plan to implement alternative schemes such as hub and spoke model. Now, just to explain to you what the hub and spoke model is, it's really that there are the hub and spoke. It's really one headquarters, and then you have small offices, which are called the spoke. So again, the reason um, is really to let the concentration not be in just one space alone. Um, what what we've been experiencing, just to share with you, what Colliers has been looking at, was that since we have the office, our own office has been split into two teams. So we call it a team A and a team B, which alternately go to office. So if team A goes this week, next week it's team B. Now, so for those who are working from home, for them it's really a challenge because they're saying that working from home is not as productive as you are going to office. Sometimes because of distractions in the homes, poor connectivity, and all those factors that they're saying, it doesn't work for that much productivity. So what our own office has been looking at since the late last year was to look at co-working spaces which are available near where the employees are residing. So they can go there and then work. It's just like going to a coffee shop and working there. But this would be with a slightly ambience where you go into one place and there would be different people working all at the same time. So landlords expand their options by offering available office space in non-core locations where tenants can avail themselves of rents about 30 to 50% cheaper than major business districts. So the landlords now are now looking at going outside of the major business districts. So this is important, especially for companies planning to implement a hub and spoke model, wherein occupiers reduce the reliance of a single headquarters location for a more dispersed occupancy strategy. So tenants continue to take a wait and see stance and look for opportunities to reduce costs and align their leasing strategies with their long-term business plans while being mindful of the uncertainties in the business environment. So the landlord should focus lease negotiations on strategies that support tenants and are responsive to their needs. Tenants also are exploring short-term, such as 6 months lease renewals during this period of uncertainty, complementing traditional offices with remote work models. Meanwhile, the few companies that are still expanding are likely to secure long-term leases and are taking advantage of opportunity to negotiate cheaper rates. Now, going into the residential sector, um, the mid-income sector is the mid-income to luxury segments are to drive the demand for pre-selling condominiums and slower completion. So what we're saying is, despite the pandemic, projects in the mid-income through luxury segments, those which ranges from 3.2 million and above, showed resilience during the first 9 months of 2020. So that means that this segment is still has the appetite to invest despite what's happening in the industry, in the economy. So the segments accounted for 89% of total launches during the period. So it also the same segment also covered 85% of total sales in the pre-selling market, up from 72% in the same period of 2019. So over the past 2 years, the segments accounted for 68% of the total pre-selling take-up in Metro Manila, and demand in the residential sector in 2021 will likely be driven by mid-income to luxury projects. So as of the third quarter 2020, Colliers Philippines data showed that projects in these segments due to be completed from 2021 to 2022 have sold already an estimated 86% of their inventory. So to tap pent-up demand, developers should continue to offer flexible payment terms and adopt property technology or prop tech platforms. This include virtual reality, tours, and automated communication platforms for tenants and property management providers. Prop tech or property technology is the latest buzzword in the industry. Um, uh, the United States and developed countries in Asia like Japan has gone a full force in property technology. So they've been doing this in lieu of the face-to-face tours and all those needed in the performance of the duties of a real estate practitioner. Delivery of 6,000 units in 2020 is down by 59% from the initial projection of 14,720 is expected for this year. There was a delivery of 6,000 units in 2020, which was 59% down from the initial projection of 14,720 units. In 2021, it is expected that completion will be of 7,270 new units, or up by 21% year on year. Around 76% of the new supply during the period will likely come from the Bay Area, followed by Fort Bonifacio, Alabang, Ortigas Center, and Makati CBD. So vacancy in the secondary market is expected to reach 13.5% by the end of 2021. And the government projected rebound of remittances in 2021, lower mortgage rates, recovery of offices leasing in 2021, and the likely rebound of take-up from end users and investors should spill over to the residential sector. So again, based on on this graph that we are showing, you can see that there really were fewer transactions in terms of pre-selling launches and take-up for the year 2020. So it's expected that in 2021 it will slightly recover, but might not be able to achieve those which we have achieved during the last 5 years. So prices and rents are to recover starting in the second half of 2021 on the back of improved office space absorption. So by the end of 2021, prices and rents to grow by 1.7 and 2.1, respectively, a reversal from a negative 13% and a negative 17.7 in 2020. So condominium developers are planning to tap the pent-up demand in 2021 should consider attractive price segments and locations for pre-selling developments. In the first 9 months of 2020, around 48% of mid-income projects that were sold during the period were located in Parañaque, Pasig, and the Alabang, Las Piñas area. And during the same period, the bulk of upscale to luxury projects that were sold were also in the Parañaque, the Bay Area, Ortigas Center and Fringe, and the C5 Pasig corridor. So these are the historical secondary prices and GDP growth. So you can see that even with the plunging of the GDP growth, there has been a healthy increase in terms of secondary capital value. Now, going into the retail sector, the offline-online strategies is to prop up retail demand and will complement purchasing power recovery. So the pandemic has caused a significant disruption to the long run of growth of the Philippines' consumer-driven economy, severely affecting mall operators and retailers. So from 2020 to 2022, retailers engaged in the food and beverage, medical, and other essential services are seen to drive retail space take-up. So these are the only segments in the retail industry which are thriving at the present. Colliers also projecting a muted brick and mortar space absorption from non-essential retailers, which essentially is what we're saying is the physical space will not be essential for non-essential retailers. So they can do the online strategies where most of the retailers are moving now. So Colliers sees the completion of about 250,000 square meters of new retail space annually from 2021 to 2024, up from 53,100 square meters recorded in 2020. So the pandemic and lockdowns have compelled mall operators to implement innovative strategies to reach consumers and adjust to slower consumer traffic. So among the malls lined up for completion from 2021 to 2023 are the Mitsukoshi Mall, the SM City Grand Central, Gateway Mall 2, One Ayala Retail, the Parkal Mall in the Bay Area, the Green Health Center, and the SM Mall of Asia expansion. So despite that, the pandemic, these are those which has been under construction even before the pandemic, and there might have been some slight delay, but they're going to be completed. Despite the substantial new supply, vacancy is seen reaching only 13% in 2021, slightly down from the projected forecast of 14% in 2020 due to increased absorption of retail space starting the second half of 2021. So starting 2021, the pace of construction of new malls will likely hinge on the improvement of the Filipino households' consumer confidence and purchasing power, and retailers' propensity to continue taking up physical mall space despite the growing popularity of online shopping. So some mall operators have introduced curbside pickup where customers are offered a contactless option to get their orders. Others have rolled out personal shopper services to reduce the risk of transmitting the COVID-19 and to enable contactless shopping. So all these retailers have already gone the extra mile in doing extra service to the consumers just to be able to satisfy that very little demand for the retail sector. So Ayala Land is offering Delivery Easy and Ayala Mall's Neighborhood Assistant. Mega World has launched its lifestyle delivery app Pick Aru. SM Supermalls has introduced Get and Go, which offers curbside and drive-through pickups for essential needs, while Robinson's Malls is offering Ring Rob, Our Personal Shopper, and our delivery services. So a number of retailers have also been aggressive in rolling out online shopping strategies. Swedish furniture giant IKEA recently announced that they will likely open their online store months before the completion of their physical store in the Bay Area. And H&M has partnered with Zalora to set up its first e-commerce marketplace, while Merrimart is pioneering the dark grocery stores concept that intends to provide a 15-minute delivery service in selected cities in Metro Manila. So by the way, the dark grocery store is really a physical store, but there are no clients. It's really one where they put in the inventory and where they source. It's like a warehouse, but it's really a grocery where you can't see from the outside. You can't see what's inside because it's really just for inventory. So that's what they're going into, the dark grocery stores concept, only to service delivery services. Over the next 12 months, landlords with rising vacancies are seen to explore the viability of converting their vacant spaces in flexible workspaces. Even the malls are now looking into converting some of their vacant spaces into co-working spaces. This is crucial given that malls are near residential communities. This arrangement should significantly reduce employees' commuting time and improve work-life balance. Also seen are some developers converting their vacant spaces into fulfillment centers or micro warehouses to enable retailers reach last-mile deliveries. So these are what you call interim uses for the malls, just to firm up their occupancy. Recovery enablers are seen which are likely to anchor the retail sectors rebound such as mall-wide sales, relaxed restrictions on public transportation, recovery in overseas foreign workers, remittances, and employment, and the passage of the amendments to the Retail Trade Liberalization Act. So these are what we're looking at to be able for the retail sector to be able to arise to the challenge of what's happening right now. So what the Colliers did a survey, which was a global survey, uh, and this is really for those who are looking at co-working spaces, and they found that those who have a tendency to go into the co-working spaces prefer the malls because they can visit shops in the mall more, they can visit restaurants in the mall more, and spend more money in the mall. So this would be as what we're saying is that a consumer spending will really drive the retail sector. Now, the leisure sector to continue reeling from the impact of the pandemic. So it has been stated in other reports that it's really the leisure sector which is feeling the brunt of the pandemic. So the Philippine leisure sector continues to suffer from the impact of the pandemic and imposition of travel restrictions. Like other property markets, the hotel segment is likely to suffer from delayed completion of new projects as developers factor in a sluggish recovery. Actually, yesterday, there was news going around that the Shangri-La, Makati Shangri-La Manila, is closing its doors starting February 1, which is really a big impact or a big what's a dampening to what's happening to the economy.
Hello, what's
So in
that?
the Colliers second half 2019 hotel report released in February 2020, it highlighted a potential drop in Chinese arrivals due to the then China-centric nature of the outbreak. So what was Colliers saying in February 2020 is that we cannot have that much reliance in terms of this Chinese arrivals because once they stop coming, we will definitely be hard hit. So the virus, which has since evolved into a pandemic, has affected arrivals from the Philippines' other major source markets, such as South Korea, USA, Japan, and Taiwan. These countries, including China, covered about 70% of the 5.8 million of the 8.6 foreign arrivals in 2019. So looking at the Philippine visitor arrivals versus the Metro Manila hotel occupancy, you can see that the occupancy was barely hovering within the 10% occupancy level. So most of the hotel guests during the lockdown, which started mid-March last year, were returning OFWs, health workers serving as frontliners, as well as professionals working in Metro Manila whose daily commute was limited by the suspension of mass transportation in the capital region. From 2020 to 2022, there is an expected completion of about 6,100 rooms, or about 2,020 rooms annually. The new supply is likely to pick up in 2021 and 2022 following the delayed delivery of several hotels in Metro Manila. In 2021, occupancy rates are projected to recover yet remain at sub 50% levels, as foreign arrivals will likely be subdued and the substantial new supply is coming online across Metro Manila. Hence, average daily room rates will decline by about 10% in 2021 from the projected 30% drop in 2020. So the recovery should be supported by the Department of Tourism's aggressive domestic tourism campaign and the implementation of travel corridors between COVID-19 free countries in Asia. So, this is just a gloomy outlook for the leisure sector. So hotel operations should be more agile given the anemic demand brought about by the pandemic and the global economic crunch. The schemes, however, should comply with the government-mandated physical distancing measures. The offering should be promoted aggressively on social media and target the millennial and mobile workforce. Hotel operators should also continue utilizing technology to enhance customer experience. The technology-enabled services include keyless check-in, smart room controls, and 24/7 mobile connectivity. So the pandemic and physical distancing protocols likely to be implemented once COVID-19 wanes only highlight the need to roll out innovative hotel services using modern technology. So what we're saying is that it must have been that driver, the COVID must have been that driver for the hotel services to move forward using technology. The last segment that I'm going to discuss will be the industrial segment. So the developers who sees lockdown-driven opportunities in logistics. So what we've been saying through the last couple of quarters where Colliers was presenting its property outlook was that only the industrial sector is the one that's thriving in this pandemic. So due to the limitations brought about by the pandemic, consumers have shifted to online shopping. And when you have online shopping, there is a need for warehousing for them to be able to put in there the stocks to be able to reach the clients on time. So it is expected the retailers will adopt an omni-channel approach as they further tap the e-commerce market. Mall operators and retailers will likely firm up partnerships with logistics firms and warehouse developers to reach last-mile deliveries. This requires an adequate and versatile network of logistics infrastructure. So Colliers expects a healthy demand for warehouses sustained by an economy that is primarily household spending driven. The segment accounts for about 70% of the country's gross domestic product. With increasing competition in the retail landscape, mall operators need to differentiate and partner with logistics and warehousing providers to keep business afloat. It is seen that developers will be tapping into the sector's potential growth as shown by the rising storage investments in the country. So data from the Philippine Statistics Authority show that transportation and storage accounted for 33% or 14.8 billion of total approved foreign investments in the first half of 2020, which is an all-time high. Developers should maximize opportunities by further adapting Industry 4.0 practices to modernize warehouses, building more cold storage facilities, exploring co-working and flexible warehousing, and converting vacant mall and office spaces into fulfillment centers. Selected mall operators have already announced their plan to convert certain retail spaces into micro warehouses, as mentioned earlier, and the demand for these facilities will likely be driven by tenants shifting to e-commerce. So potential locations for these facilities include Quezon City, Manila, Pasig, Makati, Pasay, Muntinlupa, and Marikina. So around 73,600 square meters of total warehouse supplies available in Pampanga, lower than the estimated 816,100 in the Cavite, Laguna, Batangas corridor. So more than half of the supply is still located in Metro Manila, estimated that around 825,800 square meters of leasable warehousing space that is located in the capital. Around 30% of the available supply in the country's capital is located in Valenzuela. Starting in the fourth quarter of 2020, around 179,800 square meters of leasable warehouse space will likely be offered in Metro Manila with the completion of projects such as One Luna Logistics, Recto Logistics Center, and Rosan Logistics Center by Anchorland in Binondo. So this, as you can see, that that area of the city of Manila is now going into the logistics sector. So that ends my presentation. So I'm ready for questions if you have some.
All right.